Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings, Artem. It's great to have you on the podcast.
It's good to be here, Bilal.
Great. Now, before we go into the meat of our conversation, I do always like to ask my guests something about their origin story. You obviously have quite an interesting background. You've ended up in farming, I could say, or farmland, I should say. So, what did you do at university? Was it inevitable you would end up in investing and markets in some form? What's been your journey since the beginning?
Yeah, absolutely. So a little bit of my background, Ukrainian, Russian origin, born in Soviet Union, raised in Russia. So I've gone through this really tectonic shift in economic paradigms and societal paradigms in the very short and formative years of my life. And I think the constant during those years was that our family had a bit of a patch of land, and we always knew that we could grow potatoes, vegetables, and other things that would get us through tough times. And so there's this really inherent appreciation for land that myself and actually a lot of people of my generation from that part of the world have. Education-wise, though, I went into finance, studied economics, got my bachelor's and master's in Russia, and then moved to Canada in 2007. And the fascination with finance economics actually stems from sort of the same history that I experienced, which is good economic system create a lot of wealth and prosperity, and bad ones create a lot of misery. And it's regardless of what resources you have as a physical country. Because you look at places like Israel that have nothing, right? And then places like Norway and Venezuela, and you have a lot of resources, no resources, and then very different economic outcomes. So I'm a huge believer that we have enough resources on this planet to feed everyone. And marrying those two kind of things in my life led me to creating FarmTogether, the farmland investment platform.
Okay, great. So it sounds like there's a personal connection to land that you have that many people who were raised in the West may not have. I was grew up and raised in the West, and we don't really have that same. Well, I personally don't have such a close attachment to the land. I just go to the supermarket, buy the products, and carry on. Of course, in today's world, it does feel more unstable, and I do kind of worry that maybe I should have a patch of land somewhere. But what I can get a sense of where some of these ideas came from. But what inspired you to go into investing in farmland as an asset class, or FarmTogether, your company? What led you in that direction?
Absolutely. So first I was exposed to the asset class in 2013. I was working for a private equity fund in Canada called Sprott Resource. And we were, Bilal, sorry, I think I lost you.
Oh, can you hear me?
I can hear you, but you're completely frozen. So I just wonder if I am frozen.
Oh, no, you're not frozen on my side.
Okay. Should we?
Let me ask that question again. Yeah.
Because it started breaking up a little bit. I want to make sure.
Okay. Is it okay now? Or?
Yeah, much better. Mm-hmm.
Okay, great. Good. So I can see you've had some attachment to the land through your childhood, but what's kind of led you to go into farmland as an asset class or as an investment opportunity, and creating FarmTogether as a company?
Yeah, absolutely. So I got my exposure to farmland in 2013 when I was working for a private equity fund in Canada called Sprott. So it's still very early days for farmland, but these guys were pretty innovative. And so we actually owned some land in Canada and Uruguay. And it was just fascinating to me that very few people were looking at it at the time. But back in 2013, I sort of made the mental note and then continued on with my life. And really the idea of FarmTogether came to me in 2015-16 when I was working for a big pension fund in Canada called Ontario Teachers, where they would really very proactively invest in a lot of different markets and asset classes. And so the breadth of what they were looking at was fascinating. At the same time, what was even more fascinating than they were not looking at farmland. And so as I
And when you say they weren't looking at farmland, obviously they were looking at land, I imagine, or real estate. So I suppose when it comes to land or real estate, there's the building side, commercial real estate, residential real estate, which is a bit more conventional, you could say. Then there's land that investors buy. When people buy land, what's the most common type of land like a pension fund would normally buy?
So they would be investing exactly in real estate. They had a huge real estate portfolio. They would invest in sort of infrastructure, not really land, but kind of tangential to it. They did have a timber practice. So timber was already fairly popular. So I think there was a understanding that kind of what we now call natural asset class or real asset class is an attractive market. They were not looking at it at the time, and it's a huge market. So that led me to this question. If this market and asset class is really fundamental to our lives, shouldn't it also then be heavily invested in and have a lot of interest from investors? Because really, as an investor, you want to make sure that you have assets that are fundamental to our lives.
Yeah, understood. And when we define farmland, so something like timber and forest, that's not classified as farmland. It would be more farmland that you use to grow crops or raise livestock on. So the land that's devoted to those sorts of things.
That's right.
Be classified as farmland.
Correct. Yeah.
And are there certain types of farmlands or definitions of farms? And how does kind of one conceptually think about this in terms of because I'm imagining some farm near some village in the English countryside as a kind of a farm, but I imagine there's industrial scale farms or something, and different countries specialize in different types of farming.
Definitely. So let's see. So broadly, and I'm just going to talk about United States because that's the market I know the most, the best. It's about a $3 trillion market, and broadly you break it down into two types of farmland. So cropland, land that grows crops. And within cropland, you will have annual crops. So crops that you have to plant every year, corn, soybeans, and you have what's called permanent crops. So this would be your tree nuts, your fruits. So like an apple tree, where you plant them once and then they stand for many, many years, bearing the crop. And then you have pasture land. So this is exactly where you graze your livestock. And then you have some kind of tiny portions of, horticulture. You'll have some dairy farms, kind of not related to land, but you'll have fish farms, right? So those are fun as well. Oyster farms. So there's like some kind of fringe types of farms. But really, when we talk about farmland, we're talking about cropland and pasture land, and really FarmTogether only deals in cropland. So that's kind of the market we focus on.
And you said the market's worth, you think, around $3 trillion. Off that's that, right. How much would you say is cropland?
So roughly 2.1 trillion. So it's
okay. So the vast majority is cropland. Is
that's
what,
right.
And then from an investing perspective, how should we think about investing in farmland? What's the source of return? Is it just the increase in the value of the land? Are there some returns, some kind of income that you get on the land as well? And how does one think about this?
Yeah. So you can think about farmland as the real estate in this regard, where you have two sources of income. You have price appreciation from just the land increasing in price. And to give you some idea of that magnitude, so in the United States, over the last 50 years or so, farmland on average has increased by about 5.9%. And that's been driven by inflation, decrease of supply in land, increase in demand, and
that's 5.9% per year over the last 50 years. Yeah,
that's right. Yeah, and then you have your current income. So this is the income that you receive from the crop grown on the land and harvested and sold that year, and that's where it gets really interesting. Where sort of the analogy of the real estate breaks down. In real estate, you will have rental income. Sometimes you might have a little bit of like a revenue share, but it's very, very simple. In farmland, you have that as well. You can have something that is just pure rent, where a farmer will pay you rent every year. And it's a very common thing. So 40% of land in US is rented. But you can also have, for example, we call it flex lease. So when you also receive a payment from the farmer that is fixed, plus a sort of prearranged payment based on commodity prices purely. So nothing to do with what happened on the farm, what the harvest was. It's purely what did the commodity prices do that year. You can have a revenue share model. You can have a profit sharing model. And you can have what we call, or what's called in the industry, a direct operated income, where the farm is essentially a mini enterprise. And the farmer will operate it as a contractor, receive a fixed payment to do that. And then you provide all the inputs, all kind of the expenses. So you run a full P&L.
Okay, so it's kind of every possible type of arrangement you can have there. And in your experience, what type of arrangement on the income side do you tend to gravitate towards?
We tend to gravitate toward direct operated as well as revenue, kind of fixed lease plus revenue share component.
And why the direct operated sounds like a lot more work? Is it?
It is.
Yeah. But so why do you go down that route?
So a few reasons. One is this is the area where our team has the most expertise. And that is also the model that typically has the highest risk reward profile, meaning it has the highest risk, but also the highest reward. And what we found is that with a lot of our clients, and most of our investors are accredited investors, family offices, they're looking for that long-term kind of max exposure to crop prices to farmland, because not to jump too much ahead, but farmland has done really well in periods of inflation. And so you want a structure that gives you that max exposure, because when you're doing a fixed rent, well, until you reset it, you're sort of losing out on inflation. Whereas in direct operated model, well, if commodity prices go up, that's when you supposedly will have the highest return. So that's why.
And you mentioned, the 5-6% annual returns. I mean, how does that compare to traditional asset classes? Because lots of our listeners, probably have some kind of equity exposure. They may have some exposure, obviously, to their own houses, like residential property. So how would you compare it to those sorts of asset classes?
Yeah, absolutely. So we just talked about the price appreciation. There's also the current income component, which is roughly the same. So 5% or so on average.
Oh, okay. So you almost double your returns then, if you include the income and the price appreciation.
So, that's right. And that's on average. So farmland, historically, the farmland index in US from 92 to 2021 has delivered about 10.5-11% total return, which outperformed S&P 500, outperformed bonds, close to real estate. So it's done quite well, farmland. Now, I don't think we will have those returns going forward, just because so many asset classes have been bid up so heavily. But the general target net IRRs that we bring to our platform, call it between 6 to 10%, which is price appreciation plus current income. So to answer your question on how does it compare to equities and others, farmland we view as kind of the safer part of your portfolio. It definitely isn't high growth tech stocks. It's not going to outperform an aggressive equity portfolio, some sort of derivative structures. But if you think of it sort of sitting somewhere in between bonds, kind of real estate, inflation bonds, gold, then it'll do quite well. Timber, infrastructure.
And how does it compare to real estate then? So like if you have a portfolio of residential, like REITs or something like that, I mean, how does it compare to that?
So let's see. When we look at real estate overall, so REITs, I think we had, and I'm just going to take a look at my notes as well, but I think we had about 12% return for REITs in the last 30 years or so, but with much higher volatility, whereas farmland, on the volatility, it's about 6-7%. So your Sharpe ratio is much better on farmland, historically, than real estate.
And they don't always move together, presumably. So when residential gets hit hard or has a drawdown, farmland doesn't necessarily also fall. They they follow somewhat different cycles?
They do, yeah. So in speaking historically, when we look at the correlation matrix of farmland to major asset classes, it's been 0 to negative. Real estate, farmland is somewhat correlated. So I think the total is about 0.4, but again, it's kind of the real estate overall. We start looking at residential. I'll be really curious to see some of the latest numbers. So we're still kind of getting those, but the anecdotal evidence during the pandemic, you had real estate in New York, San Francisco, the places just plummet because of COVID, whereas farmland just stayed very steady. So you had complete decoupling of that.
That's interesting. So this recent shock, I mean, if we use that as a case in point, that actually showed a decoupling between the two.
That's right.
Yeah, and I was going to ask, and how did COVID impact the operation of farms? Because lots of other sectors of the economy had all sorts of operational issues over that time.
Yeah, absolutely. So we had those issues as well. On direct operated farms, we had issues as well where you had labor shortages. And now we actually, a lot of other industries are dealing with inflation inputs, fertilizer, steel, lumber. All of those have been coming down. So you do have quite a bit of inflation pressure, which should result in higher eventual crop prices and land prices as they have already. But you do have that lag between having to pay all those expenses and getting that money back. So there is a bit of a cash flow management issue that you need to be cognizant of. When we go back to row crops, so this is typically where you have your corn and soybean fields that are more often they are just a rental model. Those ones have not been affected at all and actually have done extremely well for farmland. The latest we looked at, they are up double digits, and we had zero issues because it's all on the kind of the farmer side. And because you also, in those areas, you typically have less, it's less dense, and you have a somewhat more robust market for government support as well as the infrastructure. So permanent crops, the tree nuts, the fruits, they were almost uniquely hit by the pandemic, where you had export issues with the ports in California. You had the demand collapse because a lot of the consumption is from travel, entertainment, leisure, bars, restaurants, and that's where you eat your almonds. But what's interesting, the index overall actually stayed flat. So that's, I think, what's really important to remember when we talk about farmland as an asset class. It's not like you're investing in government bonds where it's like very homogeneous. You still have a lot of sub asset classes, markets, setups. So it is a very diverse, vibrant market, just like real estate. You could have some farms do really well, while at the same time, some farms will do poorly. But on average, we feel that the benefits definitely are substantial. And
and obviously one big issue today for investors in particular is inflation. How do you hedge your portfolio against inflation? And it does intuitively seem like farmland should be a good inflation hedge, and you alluded to that earlier. More specifically, why is farmland a good hedge against inflation? What is it about farmland specifically that provides that hedge?
Well, just looking historically at farmland performance during periods of inflation, in the 20th century, farmland outperformed S&P by 30+% during periods of high inflation. And historically, when you look at different decades, then farmland delivered returns, most of them above inflation. So that's just history. In terms of kind of looking at the first principles of that, like why is that? I think it's a few things. So one is, when we talk about inflation, it's really you print a lot of money and then the amount of physical goods stays the same. Well, land is extremely hard to create. In fact, we're losing land at click of millions of acres every few years. So you cannot. When
you say that land is disappears, what's causing that disappearance?
It's a mix of urban development, climate change, a shift of living more and more to urban. It's those. That makes sense. But so that's one, right? So just very basic math is that if you have something fixed and something else is increasing, then the fixed will increase in price. The second point is that farm products literally compose hundreds of farm products compose the CPI. So you have what's called farm feed, fuel, fiber, and then you have all the derivatives that go from that, right? Now, while I know that we like to exclude fuel and food because it's volatile, which is always baffles me, because as a consumer, well, I paid more for this. Now you tell me, but it's not inflation. Like, okay, well, I still paid more. So, and then those products then indirectly influence a much bigger basket of CPI. So you have farmland being just almost mechanically linked to the CPI. And then you have increasingly as the more institutional market comes to farming, and as companies like ours can open up this market more and more, then you have this more tactical trades happening, more investors anticipating inflation will drive more capital to farmland. Because you have to remember, it's still 98% of land in the US is family owned. So the market here doesn't really move the same as the global capital markets. It's sort of, there's thin bridges here and there, but it's disconnected. So it's not truly an asset class just yet. It still needs much more in terms of the financial linkages.
Yeah. And speaking of financial linkages, what about interest rates? Because that's been one big support for asset classes since the global financial crisis. Low interest rates, money printing, that's all ended. You know, interest rates are going up around the world. Presumably that would provide a negative hit to farmland, I assume. Is that how is that correct, or how does interest rates affect?
Yeah. So you're absolutely correct. And let me put my former macroeconomist hat on. I hope I remember some things, but one is that you do have farmland. You can view it as a long duration bond, right? 30, 50, 100 plus years, and so the longer is the term of your bond, the higher the duration, meaning the higher the sensitivity to interest rates. So farmland will have absolutely negative effect from the rates going up. A few things to remember though is that one, farmland is actually very underlevered. So, and when I say underlevered, I mean, it's a bold statement, but let me explain what I mean. The debt to asset ratio is only 13%, which I think is a suboptimal way to capitalize what is a very leverageable asset class. When you look at real estate, it'll be 50, 70, 80, 90%. S&P is, I think, 50+% levered. So from the perspective of interest rates going up, meaning that now you have more expensive debt to service your land and then you need to sell it, well, that's actually, the effect here is way less than almost any other asset class. And just
on a side note, which financial institutions provide lending with to farms or farmland as collateral? Do all the traditional banks do that, or is it a specialist part of the financial sector?
So in the United States, you have something called Farmer Mac, which is like Freddie.
Oh, okay.
Fannie. So you do have kind of that. And then you have some more specialty banks. And there's, banks that provide loans, but the loan industry also isn't that developed. You can get your traditional mortgage, you maybe can get some sort of vendor financing, but it's not the same as it is in real estate. So the flexibility isn't there actually. That's why FarmTogether, I think, is successful. It's because we're able to fill those gaps in financing. But let me then kind of take a flip side here. The reason that interest rates are rising is because inflation is rising. And so then farmland actually should be rising in price, which it has. So you sort of have that, yes, mechanically, rising interest rates will decrease the value of land, but it's only because it's increased by quite a bit because of inflation.
Yeah, understood. Yeah, and as you said earlier, it's not a market that speculative investors have piled into for the last 20 or 30 years, so it doesn't have that froth. No. Now, as there has been more interest in alternative assets over the last 5-10 years, most recently, crypto has become very sort of big. But, there's others areas like the private markets have become much bigger as well. There's also been a lot of interest in forest and timber, as you alluded to earlier, commodities, of course. What do you think has been driving this move or this focus to alternatives in general? And then follow-up question to that, do you think farmland will be one of the core alternatives for the next 5-10 years?
Well, second question I'll answer first, which is absolutely, I think it's such a fundamental thing for our living that it needs to be also core to investment portfolios. But to answer your first question, I thought a lot about this, and I had a bit of a front seat to that trend of alternatives opening up when I was at Ontario teaching this pension plan. And look, I'm sure there's articles out there that speak about this better than I can, but here's what I see in general. One is you had the defined benefit pension plans running into major issues as we came to this new normal interest rates where they just could not meet the obligations. So they had to take more risks than just government bonds. And that led to the liberalization of laws around pension fund investing, which freed up trillions of dollars of capital. And so we moved from the 60-40. So we moved from government bonds to then 60-40, like more stocks, more bonds. And from there, as the pension funds also started looking more and more into what it is that they need to do, and then sovereign wealth funds. And the reason I'm talking about these players is I think because they're the ones that move the market. I mean, retail is big and everything, but it's this really sophisticated long-term investor that I think truly define, restructure the markets, and that pull out products from them, the bankers and everything else. This is what we need to do. And so then that led to the sort of traditional asset classes being bid up. And as the pension funds and other investors continued to look for alpha for returns, they said, well, what else is out there? Well, real estate became next. And then they looked at timber infrastructure. And so there's this general understanding that at the end of the day, investing is having rights to an asset that produces cash flows. And there's a lot of assets that produce cash flows or can appreciate in price, right? So we look at things like art, collectibles. And so it's just, I think this step away from very like ivory tower academic view of investing. And that's kind of the world where I lived in, to saying, let's make some money. And so everyone is now saying, okay, what are the ways that I can invest? And it moved from being this exotic thing to something very common, very mainstream. This podcast, alternative investing, one day just will be called investing. And there'll be no difference between like, I don't know, a Pokemon card and an Apple stock maybe, or a Apple farm and Apple stock is probably better. Comparison here.
Yeah. And of course, COVID has changed so many different things. And you have an interesting background. You were on the so-called traditional, asset management side, and now you're in an alternative space, on the farmland side. What do you think will happen to the investment landscape, in the long term after COVID?
Well, the alternatives will definitely grow massively. I think the research I've seen, I believe Deloitte says that we'll go from some like $8-9 trillion in capital deployed today in alternatives. And this is up from 3 trillion in 2008. So massive increase already, to closer to 13-14 trillion the next 4 or 5 years. So that's definitely going to grow. I think from the perspective of remote work, we saw how easy it was, although there's some challenges, to continue to collaborate with people remote. And I think it's opening up the world a bit more, where people will start looking more at different asset classes, different countries even. Then you do have at the same time deglobalization, I think, is a very real thing. Reshoring going on in the US, and then securing critical supply chains, which food is the most critical of all. So it's going to be really interesting to see that play out, where US is a very reliable supplier, both from a climate perspective and just the sheer volume of food, to the shipping lanes, to the kind of the network it has. So I think US will benefit from continuing to be this really reliable food exporter. But you might see a bit of a disintermediation of this global financial flows and more local markets emerging. I mean, as an economist, it's a fascinating thing to watch. I mean, we have inflation highest in 40 years, mega trends of deglobalization. So it's historical times, and anyone's guess is as good as mine.
Yeah. And we've mentioned climate a few times here. Are you seeing the actual impact of climate on the farms that you manage and in the farmland sector in general? And how should we think about climate change's impact on farming in the next, let's say, 50 years?
Yeah. With climate, it's really interesting. Well, of course, you have overall a negative going on at a planetary level. But you almost need to think about farm investing and climate as sort of a climate portfolio. So California is the market we know best. So let me talk to that. There's obviously this issues of water and increasing temperatures that lead to this major issues with some of the. At the same time, you have others that have good water supply to benefit from the other farms struggling. And then you have warming up climates, excuse me, up north in Canada and north of US that again will sort of benefit even more from this climate change. So overall, of course, it's a negative, but there are definitely areas that do stand to benefit.
Okay, so some areas of farming could struggle a bit because of water issues, but then other new areas will open up as northern areas will get warmer, and then that allows them to become more amenable to certain types of farming than before. So it's kind of hard to make a blanket statement, I suppose.
Like the blanket statement is that it's definitely something that we need to solve. But but you're right in that. As with the trite, every crisis is an opportunity. You do have that opportunity with investing with foresight into land that will be resilient or benefit from climate change. And it's a topic we could go into for another hour.
No, understood. No, it's kind of a big issue, and we're seeing all sorts of strange weather patterns around the world. I mean, China's going through this huge kind of heat wave and drought. Pakistan's going through this massive rainfall, a third of the country underwater. I mean, it's all sorts of strange things that have been happening across the world. It's not sort of great for all aspects of many aspects of our lives. Now, in terms of the sort of more practical side of things, how would investors typically invest in farmland? And your company FarmTogether, what does it do differently that enables investors to make allocations?
So from a practical standpoint, here's how it works. We will go through literally thousands of different land opportunities that come to us through public channels as well as private channels and the partnerships we develop. Using our engine Terra, which is this internally built tech engine that allows us to really quickly source and underwrite land, we're able to then kind of filter it down to a subset that is more attractive. And then we will build financial models. We will do a lot of due diligence, and really probably 1 out of 1,000 farms will pass this filter. That farm will then be put into its own Delaware LLC. And we will find a farming company or farmer that will operate the farm. And sometimes it'll be the seller, actually, that wants to continue doing that. We will then put together an investment memorandum, a webinar. We will publish it all on our website. And then you'll be able to go online, listen to all of that, ask our team questions, make sure that you understand everything. We have really easy to understand materials, how to think about the key risks, kind of the key factors, the cash flow profile. And then online, you can sign all the documents online, wire or ACH the money, and become farm owner in a matter of minutes. So it's a very quick and easy process from a UX standpoint.
And I guess, without a company like yourself, then the issue would be that you would have to, find a farm yourself, to buy into. Or presumably, are there funds that specialize in farmland that you could invest into the fund? Or I don't.
There are funds, but typically the minimums are much higher than ours. Our minimum was 15,000. And you also have no choice over the sector that you invest in, which farm. They also tend to be either on the smaller side. So we have quite a bit of diversity in terms of farms we offer. And we're not limited as a fund is by a portfolio allocation policy, because we really just look at what our clients already have in their portfolios, what their demand is, and look to find farms that fit that. So if you want, let's say, hazelnut farm, and that fund already has hazelnut farms, maybe you want more and you don't want corn farms, well, you have no choice. Whereas with us, you can be fully in control You can also choose different farms will have different cash flows, different risk profiles, different setups. So it's really much more flexibility. But then, to that point though, Bilal, we do have a fund. So some people, they don't want to spend their time selecting different farms. They maybe want just something invest and forget. So we do have a diversified fund that you can invest in as well. The minimum there is a bit higher. It's 100K. But yeah. And then we have, just to mention a third offering, if you want to farm completely in your own name, so like a mini fund where you have one or more farms in there, and if you have the means, then you can do that with us. We essentially will be your bespoke private farm manager and farm investor that will build a portfolio for you.
And what types of investors are investing in this, do you say? Like, what's the profile of investors?
US and international investors, family offices. We have some registered investment advisors. Increasingly, we are talking to endowments, foundations, pension funds, insurance companies. So it's really, it's who's who. Because Farmland is so, I think, easy to understand and fundamental that we're finding interest from a lot of different investors.
And more, when I think sort of more globally, I mean, which other countries are big farming countries?
United States is the biggest. Out of the $10 trillion market, US is about 30%, 25-30%.
Okay.
Canada is another big one. I think it's about $500 billion. Australia.
Okay.
But really every country has farming, of course. But when we talk about the markets, and what's important to remember is that when you invest in farmland, it's such an illiquid, immovable asset that you really need to trust the government regulation, the rule of law. And so while Latin America, for example, has some excellent farmland and farming, but currency exchange risk, political risks over a period of 10, 20, 30 years are just much higher than investing in the United States or Canada.
Okay, yeah, no, that's interesting. And I mean, a final question I wanted to ask, I mean, we could go on more about this, is just the question of technology and farmland. You imagine there is I mean, technology can be used in farmland. I mean, has there been much innovation in that space? I mean, you see these kind of giant industrial style sort of farms which use kind of like drones and sort of different sort of machinery to farm the land. Is there much innovation in that space? I mean, is that something that would reduce the operating costs of farms or sort of make land more provide sort of more crops or service more livestock?
Yeah, I mean, a ton. There's dedicated AgTech VC funds. There's a ton of innovation all across the kind of the value chain, all the way from genetics and seeds to new types of fertilizer, and going, of course, into what everyone kind of thinks about drones, all the fun things, and we definitely use drones all the time. Satellite imagery, multispectral imagery, on farming equipment for different harvests, because that's the most labor-intensive part, to monitoring and software. On our end, a lot of innovation besides the farm management component comes from the farm sourcing and underwriting component, where what's important to know is that farmland in the US is such a fragmented market that most farms are small to medium sized, and they're not like you can go to Zillow, Bloomberg, and just click somewhere and find that farm, see how much it's worth. It's very disconnected, and so you have to do a lot of work to kind of bring it all online and to properly underwrite it. So that's a lot of what we do, being able to automate our investment process so that it becomes actually economically feasible to bring that investment to investors, because otherwise it's just so expensive to use kind of manual investment analysis work and getting information that it just becomes slow and prohibitive to allow you to invest in a farm. That's actually a big reason why farmland investing has not taken off as much, because of that fragmented nature of the market.
Yeah. And I saw you have something called the Sustainable Farmland Fund. Mm-hmm. Is that the fund you referred to earlier, or was that something different?
That's right.
And when you say sustainable, what's the sustainable part of it?
So we are part of a standard that the farmland industry recently rolled out called the Leading Harvest Standard. It is a set of principles that talks about the different aspects of farming. So you have parts related to soil management, parts related to how do you work with community, parts related to how do you treat your workers. And so it's an evolving set of standards that we are part of as well. So there's more details that we can provide on the website.
But I'll include a link to your website on the show notes. And presumably on the website, you also just have background information for people who aren't that familiar with this asset class and so on. I mean, it's certainly something that's really piqued my interest, hence why I invited you to this show, because we're always struggling just to find types of assets that will do well in this inflation environment we're in. We kind of have to think out of the box. It seems almost like every single asset class has been hit. But farmland certainly looks interesting in the sense that it should, from first principles and also performance, it should do well in an environment of higher inflation. And then also just if you look at all the other sort of challenges, whether it's climate change or just other challenges, it does seem like farmland should do quite well, or onshoring geopolitics as countries want to have food independence and so on. So all those sort of the mega trends seem to be sort of pointing to quite an attractive backdrop for farmland.
Yeah, absolutely.
And, I did also want to ask some personal questions as well, which I always do to all of my guests. One is, and you have quite a varied background, but what's the best investment advice you've ever received from anyone else?
Long-term thinking.
Yeah. No, it's great to remind people about that, because it's so easy, especially if you're on social media or in front of a Bloomberg screen, to get really caught up in the very short-term dynamics of markets. But yeah, absolutely. And the other thing we have found is many younger people who are just leaving university come to me or others at Macrohive and ask us, what should we do next? And so let me push that onto you, Artem. What advice would you give to young people who are leaving university, entering the jobs market?
Actually, it's going to be the same. Long-term thinking is make sure that you spend time understanding what you really, not even like necessarily deeply passionate about, because sometimes those things don't overlap. And when they do, you tend to lose the passion when you marry the sort of the passion to work. But it's like understand what you're really good at and just working at it, because it's this law of exponential returns. If you keep at something for long enough, you become really good at it. People get to know you in the industry, you develop a reputation, and then it just becomes very easy, and you get to kind of get into this flow state where it's almost like art in what you do. And so, I think that would be the advice I would give to the young people.
Yeah, no, that's great. That's great. And I'm always looking for hints about productivity and so on. So I imagine you're overloaded with information. You've got a lot of work to do all the time. But do you have a system to manage your time or to make sure you're productive?
I do have a system. It's fairly long, but if I had to kind of maybe take a tip out of it. Yeah, make sure you clear out your inbox. It's not that hard. You can just really quickly, because it frees up your mind, and that you don't need to remember too much. And then look, we use Asana extensively. It's a great tool, so I highly recommend it.
Okay, no, that's a good one. And then finally, I'm a big reader, and so what are some of the books that have really influenced you over your career?
Principles by Ray Dalio. Used to read his letters even back in 2008-9, and it's just the way he explains so simply complicated concepts just shows how deeply he understands it. I know that it's been a bit of a mixed track record at times with Bridgewater, but it's sort of the fundamental truth about life remained the same. Nothing is new under the sun. And so his basic principles are, understand what's true and what do you want to do about it. And it's just so simple but complex. And it's just, I think, I reread it all the time, and I think it's something that is timeless and really, really helpful, especially for people in financial markets.
Yeah, that's great. Now, I mentioned we'll include a link to FarmTogether's website. Are there other ways for people to follow you?
Yeah, so we are on Instagram, we are on LinkedIn. I'm on LinkedIn, Artem Milinchuk, on Twitter, FarmTogether. So, but I would say making sure that you register on our website is probably the most sure way to make sure that you don't miss anything. And we put out monthly newsletters. If you invest in a farm, you get this also videos and photos. Sometimes we'll do little interviews with farmers, so it's a lot of fun.
Right.
Get that when you invest in the diversified index.
I like that. I'll include links to all the different sort of social media stuff as well, and a link to the registration on the site as well. So with that, I mean, thanks a lot. I've learned a lot. It's definitely something I'm going to explore, further myself. And it's been very informative speaking to you. So thanks again.
Thank you, Bilal.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.